morning, all. We just want to say thank you again for joining us and taking this opportunity to learn with Legence as we talk about some of the Libor changes that are upcoming and what that might mean for all of you or your clients in obtaining financing. Just a reminder that we are in moderator mode today and that all participants are muted and some may be hidden from view. If you have a question, please simply enter it into the chat box and we will address it when feasible. Just a note, we will also be recording today's presentation as we have had a lot of individuals reach out to us that weren't able to join us this morning, but certainly want to see this important content and hear from Alan. I look to have this video pretty much taken care of later today, and Legence's marketing team will be able to upload that as they'd like. Now, without further ado, I would like to introduce Mr. Alan as today's presenter. Alan is the Senior Vice President and Chief Credit Officer with Legence Bank. With extensive banking experience and specialization in credit analysis, Alan is the prime candidate to discuss the upcoming changes to financing standards and how it will affect local and regional banking institutions. So with that being said, I will now turn it over to Mr. Alan.
Good morning, and thank you, everyone, and I appreciate your attendance and interest in this topic. You know, I guess it really starts off with what is Libor anyway. Libor, by definition, is the London Interbank Offer Rate, and that is the rate that large banks indicate they can borrow short-term wholesale funds from each other in an interbank market. Obviously, by its name, it started in London, which, you know, what's really fascinating is to think that, you know, we're in Southern Illinois, we're in Southern Indiana, where I am, and we're talking about a rate that originated in London because it had that much impact on the entire world and borrowing market. The origins of Libor go back to 1969. With a syndicated loan that was based on reported funding costs of a set of reference banks. Now, I said reported, and even when I talked about the definition of Libor, I said it's the rate at which banks indicate they can borrow. Those two phrases are key because irregularities occurred in the 1980s when reference banks started borrowing based on the offer rates. Since they were borrowing on those rates, they had an incentive to underreport the actual borrowing costs. So that, in effect, lowered their borrowing costs. As a result of this, in 1986, the British Bankers Association took control of Libor to formalize data collection and governance. It also began being denominated, I should say Libor began being denominated and traded in multiple currencies. By 2012, there were 10 currencies that were denominated and trading Libor with 15 maturity terms for each currency. So it really gained in the late 80s, throughout the 90s, into the 2000s, a very wide following, and a large group of countries were adopting Libor and using that as a method to borrow. In the aftermath of the financial crisis of 07, 08, 09, supervision of Libor shifted to the ICE benchmark administration by the Financial Conduct Authority. This is UK's primary financial regulator. ICE is an independent UK sub, though, of the US-based Intercontinental Exchange. Many countries dropped their own currency-denominated Libors, and then the number of contract maturities started to decline. So with the irregularities, which I will talk about here in a little bit, that occurred in the financial crisis, confidence in Libor started to erode. So Libor was used as an actual rate and a benchmark rate. The difference there being, as an actual rate, it was a reference rate, meaning that is what people were borrowing at. As a benchmark rate, it was a relative performance measure. So, you know, you would compare things like Libor to prime rates, you would compare Libor to other fund rates, and look at how those two rates would move either parallel to each other, or in some cases there could be spikes in one, flatness in the other. So, though that was being used to look at changes in the financial markets, to see what risk patterns might be emerging, things like inflation, inflation in one country compared to another, which was pretty key at the time. At one time, there was in excess of 300 trillion LIBOR contracts in place. $300 trillion worth of LIBOR contracts were in place. And one of the biggest products it was used for were adjustable rate mortgages. So your Fannie Freddie mortgages that were being offered with adjustable rates, as well as the private student loan market, where those were based on floating rates. So I mentioned some irregularities and problems with LIBOR. So the first occurred during the financial crisis, and that was due to heightened volatility with what's referred to as counterparty risk and liquidity concerns. So with counterparty risk, what you have are two different entities, two different banks, call it Bank A, Bank B, where Bank A is doing a swap, and they're doing the swap with Bank B on behalf of a customer. This was a large market at the time, because what it allowed customers to do is they could fix their rate, while the Bank A, only was offering a floating rate to them. Bank B then, being a counterparty, was swapping that fixed rate in exchange for the floating rate for one of their customers. And again, all this is done from a customer standpoint, from a borrower standpoint, to if your view is, if you think rates are going to decline, you're going to want a floating rate. If you think rates are going to rise, you would want a fixed rate. So that counterparty risk initially created concern, because all of a sudden, with the financial crisis hitting, the credit worthiness of the counterparty started to decline, and there were concerns of the risk that the counterparty could default. So that was one issue. Then the other was liquidity, which really starts to tie into the counterparty risk, because as contracts start getting called, pulled in, less of them issued, then that created liquidity in the market, or tightened liquidity in the market, I should say, and in essence also then drove up counterparty risk. So really what became evident was there was a pullback of interbank lenders. So reasons cited for elevated interbank rates stems from supply and demand. On the supply side, banks were unwilling to tie up funds for a long period of time due to balance sheet uncertainty that was brought about by the blossoming subprime lending markets, which created term liquidity risk. Conversely, the fear of instability drove the same banks to demand more long-term funding for their own liquidity purposes. So you had a burgeoning demand chasing a shrinking supply of interbank funds, and that was compounded by perceived risk in credit risk arising from subprime sectors. All this caused LIBOR to go to new heights. The other issue that occurred in the wake of the financial crisis, and this was not during the height of the financial crisis of 07, 08, 09, but actually occurred afterwards, is a fairly large scandal in 2012. So LIBOR, well, it came to light in 2012, and it was occurring shortly after the financial crisis. But what had happened was several banks, and these have all been in the press, but these are large multinational banks: Deutsche Bank, Barclays, UBS, the Royal Bank of Scotland, and Rabobank. They actually underreported their funding costs in an effort to project strength, whether or not the strength was accurate. So, in essence, they were trying to send the market signals that they were doing better than they really were. And since the LIBOR was an indicated rate where people were self-reporting their borrowing costs, they had an incentive to say, hey, my borrowing costs are low, and that made them sound stronger than maybe they really were. The other thing that occurred then was you had some unscrupulous traders that worked for these banks. And these traders were trading LIBOR contracts based off these lower rates. So you really had two things occur. The traders made money because they were working on a commission basis. The banks made money because the trades were going through their trading desks. And then also the banks were able to borrow at costs that were less than what was accurate, or at least they were reporting that to the market. As a result of this, true comfort in LIBOR eroded because it became evident that LIBOR could be manipulated. It was really no longer an accurate measure of the market because of the fact that people could lie about what their borrowing costs were, and that it presented that false strength to the market. In the end, these banks paid fines of $500 million to over $1 billion each. So it did catch a lot of regulatory scrutiny, which it should have. But again, the unfortunate thing is it eroded confidence in LIBOR as a benchmark. So as we sit here today and look at the future, LIBOR in the US will cease being published after December 21st of this year, 2021, for the 1 week and 2 month contracts. All other contracts, even though they will be out there and can be traded until June 30 of 2023, they're really being deemed as unrepresentative by the market. So even though contracts may exist into the future, they're deemed unrepresentative. So 12/31/2021 is really viewed as the effective end date of LIBOR in the US. So as a result of this, the markets are demanding and seeking a new standard for overnight pricing, for short-term pricing. What has emerged in the US is called SOFR, which is SORF, and that's the secured overnight borrowing rate. In the United Kingdom, what's coming to bear is something called SONIA, and that's the sterling overnight indexed average. Other countries are now adopting their own currency denominated forms of pricing similar to both SOFR and SONIA. Effective with 9/30 of 2020, the Alternative Reference Rate Committee suggested that debt arrangements be priced based on new reference rates, or at the very least, any LIBOR denominated contract should have language that provided for an alternative base rate. Again, this is key because if LIBOR ceases to be traded, if the contract maturity goes into the future, the creditor still needs to have a way to price that debt product, and the borrower needs to have a mechanism to know what that debt product is going to cost them. You know, we've looked at some of our own contracts at Legence Bank, and we don't have very many LIBOR-based loans, but the ones we do have include some exclusionary language that says in the event LIBOR is no longer traded, we as the bank will select an alternative rate, and we work with our customer on that. So that is important because without that fallback language, it would be difficult to know for the bank how to price your loan, and for the customer what my loan pricing is going to be. So the main differences between the SOFR, the secured overnight financing rate, and LIBOR stem really for two things. One, SOFR is a secured rate. It's based on Treasury securities being held as collateral in the widely traded repo market. But one thing that's a drawback to SOFR is it's a historical rate, meaning it looks at yesterday and periods prior. Libor was interesting in that it was an advance rate where it was quoted as the rate for the borrowings for today and into the future. The other thing that Libor was that was unique about Libor is it was an unsecured rate. So here in the U.S., we're now moving to a secured rate versus Libor as an unsecured rate. The net effect of that is that we would expect the SOFR rates to be lower because they're secured and the collateral backing them are treasury securities. So what creditors are going to need to do that are using SOFR versus Libor is build in effectively a higher spread. It's not because the net price will necessarily be any higher to the customer. It's really a function, though, of moving to a rate that is going to be almost a risk-free rate in SOFR. So the spreads will naturally be higher. And then, really, I guess, as I look at this and look at the markets that are impacted, in Southern Illinois, Southern Indiana, most community banks probably don't use Libor and haven't been using Libor for very many contracts. I would say the majority of those have been secondary market loans for adjustable rate mortgages. Again, things like Fannie, Freddie, also Farmer Mac rates. They've been used for loan participations in the syndicated loan market, where a bank will purchase a piece of a loan that is a much larger facility, those generally being led by one of the money center banks like a JP Morgan, a Citibank, someone like that. So, what most loans are priced off in our markets is really prime or a treasury index, something like a 1-year US Treasury security, a 3-year, a 5-year for term securities, or for term loans, we offer a fixed rate. As we look at the reliability and where SOFR is headed, currently daily transaction volumes range from 700 billion to $1 trillion. It is administered by the New York Federal Reserve Bank and reviewed by the New York Fed Oversight Committee. And again, while there are some problems with SOFR, again, with that being that it's a historical reverse look and that it's a secured financing rate, the market seems to be looking at solutions for that. And by that, what I mean is they will look to develop averages that can either work as forward-looking or at least provide what I'll call smoothness, so that the rates don't change necessarily daily, but they have a smoother line. Maybe it's a 1 week or a 1 month period, so that from a borrowing cost standpoint, the customer is subject to less fluctuation. And also the market is looking at terms that will compete with the various maturities that Libor offered, or at least complement what that was. The considerations for banks and for customers is really, as I look at it, these. What rate is going to apply if the current financial instrument does not have a Libor fallback? What rate is the lender proposing? How will it be calculated? When will the new rate take effect, and how will the spread be determined? The key here is for any borrower to not be taken off guard, and for lenders to be sure they understand their loan portfolio and how their loans are set up, so that they can communicate effectively with those customers in the future. And that wraps up my comments. Alex?
Absolutely. Thanks, Alan. I don't see any questions in the chat right now. Does anybody have anything that they would like to interject or ask Alan? Okay. Well, Alan, if there's any questions that come up, I will email them over to you and we'll make sure that we get those answered. Otherwise, we will have this presentation recorded. Oh, it does look like we have a question. Does this mostly apply to non-secure loans?
I wouldn't say that. In my history of banking, particularly, I spent a good chunk in Indianapolis, Indiana, and we used LIBOR-based loans for secured and unsecured. We used them on a secured basis for lines of credit. We used them even for term assets, real estate secured even. So that it really, LIBOR can be used for anything, but LIBOR's underlying basis was an unsecured overnight borrowing rate between banks. That was its basis, but it was not just used for exclusively for unsecured credit.
Okay, let's see if we've got anything else. What has been the difference in the LIBOR rates versus what you expect to have in the future, and how are they similar?
So LIBOR has generally been a lower rate. And I say generally, because obviously with the financial crisis in 08, 09, we had some crazy things happen with rates. And so by lower rate, I'm talking LIBOR has ranged from 15 to 20 basis points of daily trades up to 1%, maybe 1.25%. So, LIBOR has had some variability. So far, and again, I mean the secured overnight funding rate so far, it has been trading recently around 5 basis points. So a very low rate. Now, what's interesting, and I looked at some charts on so far because I was curious about this question myself. About a year and a half ago, the SOFR rate jumped up to around 5% for about 2 days. And again, as that was tied to US Treasury securities, we did see some movement in short-term rates, obviously around the time COVID hit. If you think about March of 20, April of 20, when the stock market took a 35% drop, at that time, the SOFR rate grew. Also, what we had noticed then was we did start to see, and I don't want to get on a different topic, but a slightly inverted yield curve, meaning short-term rates were higher than long-term rates. So it made sense, but it was interesting looking at that chart because what you had was SOFR running here, it shot up, eased back down, and now, as I say, it's trending at around 5 basis points. Again, LIBOR is, I didn't check the current LIBOR rates, mainly because it is going away, but traditionally it's running in that 15 to 30 basis point range though. So a little bit higher because it's an unsecured contract.
So the US will more than likely use US based rates rather than the global rates. If so, does the increasing inflation likely to lead to higher interest rates for borrowers?
So the first question is yes, I do think we're going to be using the SOFR. That seems to be what's coming out and is being a standard. The other thing I will make sure everyone understands, though, even though it was the London Interbank Offer Rate, it was a US dollar denominated LIBOR rate. So we weren't trading based off the euro or sterling. Those contracts actually were US dollar denominated. That said, one thing we see with inflation, generally inflation does bring about increased interest rates. And what happens is central banks will look at inflation. They'll see that it's rearing its head in an effort to try to stave off inflation. They start raising rates to really rein in consumer borrowing and business borrowing. That effect generally will slow down inflation and bring it back in line. So yeah, I would say you would expect to see rates go up if sustained inflation increases.
Okay. I think that is everything. Is there any other questions? Okay. I'm not seeing anything. Like I said,
Okay.
if anything else comes in, I will email it over to you, Alan, and we'll make sure we get that out to this group.
Perfect.
We truly appreciate your time today, and we appreciate everybody joining us for this wonderful presentation.
All right. Thank you, everyone. I appreciate it.
Thank you.